Welcome to this week's strategy session. Great to have you with me. Heaps of interesting things to go through tonight. We've got some big movements in the US market, breakouts in the Aussie market, movements in the commodities. So I think we've got a really interesting show ahead. I'm not doing a live strategy session this week because I'm not at home. I'm on holidays, on school holiday break with the kids up on the Gold Coast, escaping the winter chill in Sydney. So one video this week. I'm doing everything in the one video, US, Aussie, commodities, all in one. As always, everything today is general commentary only, doesn't take your personal situation into account. Having said all that, I think we should get in that first chart of the week. So let's start off with the SP 500. And look, a significant week for the S&P 500. Another all-time high, having a pullback on Thursday. This upward trend remains in place. No surprises there. But that's not the significant event that I want to talk about. It's not the significant price action, which I think we really need to focus in on the moment. We'll come back to this in a little bit. This is a nice, clear upward trend. Nothing has changed there. What I think is really important to focus in on now is what is going on in the S&P 500 equal weight. Now, this is an area we've focused a lot on over the last few weeks, probably the last few months. What we're seeing here, this is just on Thursday, so I'm recording this on Friday morning before the ASX open on Friday, so of course before the Friday US session, but we've got the Thursday close. And what we have here in the S&P equal weight is we're now starting to see this lift off the moving averages, rallying off the 100-day moving average, and then I've got the 50-day here as well. And what we've had in the equal weight over the last month, we've had this compression band develop, really tight range, really not seeing much movement in either direction. And we've been waiting for the market to show its hand, which way was it going to break. There's always been that bullish bias in place because we've had the rally from the October lows, sideways consolidation for 3 or 4 months now, and so the bias always goes with the previous trend. And now we're starting to see this lift off from this small base, from this small range, which is then also part of this larger range from the April high. So I think this is really interesting. And I think what this shows us is that for the first time in months, we're starting to see signs of broad participation in this rally. And that's really been the missing link. The missing link has been, it's been a handful of big cap tech stocks doing all the heavy lifting. Most of the stocks, the broader market has just not been playing along. That could be changing now. Another thing I want to show you, which helps demonstrate that, is when we look at this indicator, it's a percentage of S&P 500 stocks above their 100-day moving average. And last week we were talking about like how I was watching where this went from a position where around 44% of stocks were above their moving averages. So of course that means 56% were below their 100-day moving average, not something you'd normally expect in a bullish phase of the market. So this was a key thing to watch. Was this going to continue to unravel to the downside, which would have been negative? But what was interesting was it was finding resistance to going lower. We spoke about this last week. It was struggling to get lower. It had previous attempts to break down, as you can see in this indicator. Didn't happen. Now we have this rally back, strong rally back, above 50%, closed on Thursday at 58%. So now 58% of stocks are above their 100-day moving average. I think the potential here is for this number to increase. Should that increase, that should see the equal weight increase, which I think then ultimately flows through the S&P 500. So I think some important developments going on in this the participation story. Coming back to the Russell, well, actually, let's go over to the S&P 500. We'll come back to here. I think the play remains stay long. That's been the case since the index got above the moving averages back in November. Stay long, let profits run, use trailing stops, And the beauty of the trailing stop strategy is that it helps see off those consolidations like we've had in the equal weight. If you've got a nice wide trailing stop, you can see these consolidations off in a lot of stocks. And my focus remains on the components. This is what I said last week in regards to, if you buy the S&P 500 index, you're effectively buying a handful of big tech stocks. That's been working well, but I don't really like chasing stocks which have rallied hard. Happy to hold them, don't necessarily want to chase them. So I think the opportunity is in the stocks which are rallying off their moving averages, which are breaking out. That's what we're seeing in the starting to see in the equal weight. I think the opportunities are within the components of the S&P 500, not necessarily the S&P 500 itself. It's down. It was down on Thursday. Not a big deal. It's just a pullback, more than likely. But the big gain was in the components, not in the 4 or 5 big tech names, which have been driving it. Now, if you're getting some value from this, please hit that like button, leave a short comment, just, hey, thanks for the video. It just shows YouTube you're watching, you're participating. YouTube does its stuff, shows other people, so please do those things. Hit that subscribe button if you haven't already done so, and it helps the channel heaps when you do those things. So please do that. Like and subscribe and comment. Now, let's what do I do now? I want to quickly jump over to the Russell 2000, the small caps, because this is significant. This is something I think we need to be aware of. Now, what's really interesting, on Thursday, so on Thursday, the NASDAQ had its 4th worst day of the year. Quickly jump over to the NASDAQ and show you, not a big deal, but nonetheless, 4th worst day of the year was down 2 and a bit %. And at the same time, we've got the Russell. Come over to the Russell. It's had its best day since November 2014. So that's nearly 10 years. It's had its best day. And why is that? Well, it was the inflation number that came out for June. Saw a negative print for June. Down, inflation was off 0.1%. And it's the first monthly decline in something like over 4 years. So that's a pretty important thing. I think it's a real psychological shift as well about all this talk of high inflation. We've now seen a negative print. And of course, lower inflation often leads to lower interest rates, which is a good thing for the small caps. These small caps do best in declining interest rate environments, not hiking environments. And what we've got in the price action, so that was a little bit of the fundamental driver behind it. The price action is what interests me most. Now, look at this. This is a really powerful gap higher in the Russell, in the small caps. And this has been really just dragging sideways for months now. Now to get this powerful upward gap, and it's also on expanding volume, which is another important thing. So there's money now. This has been the thing. The money flow has not been into this sector, and now we've got signs that maybe that is starting to change. Maybe we're at a point where money will come into this sector, and I think this presents a significant opportunity in the making. Now, Russell's been consolidating all year, and I think this breakout is a real sign that we need to pay attention to, and potentially says this consolidation period has now finished. Now, just having a look at, let's just have a larger look at this. Let's just compress this. Have a look. So these are the lows from 2020. Strong rallies also always lead to big consolidations, and we got the consolidation and the decline. Then we had the base building period, 18 months of base, strong rally into the end of last year. And again, as I say, strong rallies lead to consolidations. This is what I think we've been seeing over the last 6 months. We've had that big sideways consolidation. Now I think we've got another base in place, which then leads to the potential of another leg higher. I think that's the opportunity which is currently presenting in the small cap. So go through, look at your small caps, look at the setups in the individual stocks. I want stocks which are above rising moving averages, not about picking lows in stocks which are still falling, because there are still stocks which wouldn't meet a trend following entry criteria. But I think if you find those stocks which are breaking higher, above rising moving averages, I think they present the opportunities at this point in time. Now let's leave the US market there. Let's come over to the Aussie market, and it's finally happened. Finally, after what, 4 or so months of tracking sideways, we have a breakout. We have a breakout in the ASX 200, and as things will stand here, that looks like an all-time high. So Friday is going to be an all-time high for the ASX 200, and this is a thing. Like, we've been tracking this range since it began forming in April, and came back to the moving averages. It's been tracking along those moving averages for as we say, for 4 or so months now, and the price actions continued to contract. And this is the thing with a trading range. Periods of dull activity, of general inactivity in the market, almost always leads to expansions in the price action, expansions in the activity, and that's where trends form and new trends get underway. I think that's where we are at the moment. I think we've got to say the benefit of the doubt now goes very much to the upside. We have a breakout. I think the play is you go with the breakout and you see where it takes you. And what's interesting, I think, is that the breakout we're getting in stocks, you could say stocks generally if you include the US and other parts of the world, but let's just focus on the ASX. It really does defy the media coverage that we've been having in recent months, or really over the last, you could say the last year, where it's been a crisis in everything. So you name it, there's a crisis. So it seems like it must be a particularly bad time to be an investor, and the safest place is out of the market. But we often get this. We often get where the news feed and the price action are out of sync. And this is very much the case at the moment. We have a market breaking to all-time highs whilst the media continues to tell us about the crisis in everything. I think the best we can do in markets, really, it's to go with the trend. Let the trend lead the way, and then manage the risk around the trend. And when you get a breakout, I think the biggest risk is probably to ignore it. To make excuses, to say, look, it's breaking out, but things are going to top soon because of this and because of that. I think the risk when you do that is that the market continues on upwards without you, and you're left on the sidelines watching while things continue to increase. Now, should this prove to be a false break, always a possibility, we can address that risk by using simple strategies like a stop loss. So if you're to buy the market on the breakout, you have a stop loss back, it could be back just below the 50-day moving average, back within the range, or even a more aggressive stop at a higher level, back at towards last week's lows. And so if the market falls back on itself, it doesn't stick, it doesn't get followed through buying, you've got a way out that doesn't cost that much money. But if it does go, and you use that wide trailing stop to try and stay on board, you could be on a trend that lasts for 6 months, 12 months, 18 months, or longer. So I think that's the risk of fading a break, that you're on the sidelines watching as it continues to go. We can manage the downside risk. You can't go back and rewind time and get back in if you miss these things. Just overviewing this market. So let's just compress this a bit. Just go back to the March lows, just like we were doing in the US market. We had that big rally into the 21 highs. Then we had that, look at this consolidation, 18 months or 2 years almost of consolidation going sideways. We've got that initial run from the October lows last year, the sideways period. I think the path of least resistance remains to the upside. That's been the case all of this year. The path of least resistance has been to the upside. I think it continues to do so now. I've added some exposure through the week, individual stocks, as well as yesterday I was buying some ASX 200 ETF. So I do a lot of stuff in the individual stocks, particularly in the small to mid caps. But then there's also other more longer term positioning, which I can do through an ASX 200 ETF. Got the breakout. For me, it was a case of put some cash into those ETFs out of the cash account and into the market. And the other thing to mention is all-time highs. People worry about all-time highs. They think, look, an all-time high means the market must be due for a fall. But as I've told you before, the funny thing with an all-time high is that all-time highs tend to lead to more all-time highs. They tend to cluster. They're not isolated events. You get an all-time high and then that's it. You won't get another all-time high for months. They tend to lead to a run of all-time highs. Not always. You're always going to get a case where you get an all-time high and then that's it for months or even years. But often it's a series. It's a series that we don't know where the end of the series is going to be, but it's a series. So I think there's a good chance we do get a series of all-time highs in the ASX 200 over the balance of the year. Now, I'm going to move on to the small caps in a minute. Gold, all the commodities, having a look at those. Stock I want to mention. But of course, that wraps up the free section. So if you're not a strategy session member, I've got a link below. You can click that, come in. Doesn't cost very much, and hopefully you get a lot of value by coming in. A lot of ideas which otherwise you may not have had. So let's get into that now. Let's jump over and have a look at the. Let's start with the Small Ords.